If you're looking for ways to bulletproof your balance sheet, you've come to the right place. My guest today grew up on a dairy farm in North Dakota and went on to cut his teeth as a lender during the 1980s farm crisis. Well, fast forward 40 years, and he's joining us today, bringing us the insight and wisdom that he's gathered and what he is keeping his eyes on as we look at the super cycles that are happening in the farm economy and how to best prepare for the future. We'll be talking about that and so much more here today on the Uplevel Dairy Podcast. This is the podcast for dairy farm owners, managers, and advisors who are committed to profitability, sustainability, and excellence. I'm Peggy Coffeen, and it's my mission to bring you the conversations that will uplevel your skill set and your mindset so you can be a top performer in the dairy farming business. A few weeks ago, I had the opportunity to attend the Ag Views Live event hosted by Bell Bank, where Agribusiness Development Director Lynn Paulson shared what he is seeing when it comes to the super cycles that revolve around the agriculture and the farm economy. So we'll be tapping into knowledge and experience here today on the Uplevel Dairy Podcast as we talk about the top dollar that he is seeing farmland go for in his area, the trends in both buying and selling, why he's watching the machinery market closely, and the trends in the global and the U.S. economy that he is keeping a tight pulse on, and what all of this means for your farming business. Enjoy this conversation with Lynn Paulson from Bell Bank. Lynn, tell us a little bit about who you are and what you do.
Well, I'm Lynn Paulson. I'm Senior Vice President of Agribusiness Development at Bell Bank. Bell is a larger regional bank, one of the largest independent banks in the country. The majority owners are a couple of original farm families, so the roots of Bell are still pretty well deeply rooted in agriculture, despite the fact that we branched into more major metropolitan areas. I actually grew up on a small family farm in central North Dakota. We were dairy farmers, milked in stanchions, whatever, separated cream way back in the day. And one of my most prized possessions is an 8-gallon cream can that's in my office at home that's got the brass nameplate with my dad's name on it. So when you took the cream to the creamery, you made sure you got your cream can back.
In your heart and in your root, you were a dairy farmer. As you talk about those years that you grew up on your family dairy farm, did you have a pipeline?
We had the buckets and the straps and the whole works, so yeah, been there, done that.
So you've carried a few milk cans in your day. And of course, dairy's come a long, long way since then. And so has the farming industry. As you have been particularly working in the lending world, you've seen a lot. And one of the things that you have seen are cycles that continue to happen and repeat themselves. We call them these super cycles. And recently, you were part of a multi-day, multi-state blitz of sharing the insights on what you've been observing in the super cycles. And that was called Ag Views Live that Bell Bank put on throughout North Dakota, South Dakota, and you made a little stop here in Wisconsin where I had the opportunity to listen to that presentation as well. You, as well as Dr. David Cole, gave that presentation. There were so many strong pieces of information coupled with knowledge and your wisdom and experience that you shared. And I've asked you to jump on with me today to recapture some of those key points. And so what we'll be covering today with you, Lynn, is revisiting this concept of what you have seen throughout these cycles, the cycle that we're in right now, and most importantly, what farmers and dairy producers and really all of us who are professionals in the agriculture community, what we should be keeping our eyes and our ears on based on what's happened in the past and where things could be headed in the future. And so as we get into this, one of the things that you had honed in on was in regards to farmland trends. What are you seeing, Lynn?
On average, farmland's gone up in the last 25 years, maybe 4 times, right? Fourfold, and annual returns of 6 to 7, 8%, which is outpacing inflation by 2-fold. So it's been a great investment. But I always say buying farmland, and it's kind of like having kids. You never think you can afford it, but you always make her work. I know when my wife and I bought our first quarter of land, we probably couldn't afford it. It became a forced savings account. I mean, we made sure that we made that land payment before we went out and lived a good lifestyle and things like that. So you built a good base to do. It'll be interesting to see where farmland values go a little bit, especially on the investor market, right? Because to them, buying farmland is more of a math problem. For farmers, and I still consider myself a farmer, it's still an emotional purchase, right? Emotion takes over, and especially if it's a piece of land you've been looking at for a long time and strategic, you probably potentially could overpay. But for the investor, they can go out and get a 5 or 6% return on their money in a CD or some other safe investment. Maybe that takes the luster off of buying farmland. So are we going to continue on this trend up? I guess if I knew that, I'd be a pretty smart guy. But I think that the highs are maybe in on average, whatever. I think the big thing that's coming here, though, Peggy, is two things. Number one, especially in the grain industry, we're going into a pretty significant downturn, I think, right? And it's interesting, over the 3 days of presentations that we did, there's a lot of bankers in the room. And I would tell you, there's probably more concern in the banking world than there is in the producer world, a little bit about what may be coming. And of course, bankers, we're downside risk guys, right? I mean, we're managing downside risk, and producers are as well. But producers are busy raising their crop. They're generally pretty optimistic and things like that. So they're probably, I won't say they're not concerned, but I think bankers are probably a little bit more concerned in terms of what's happening here. But overall, again, I think land has been a great investment. I think it'll continue to be that way, but it'll be more strategic. I think the last thing about that is that there's going to be a phenomenal intergenerational transfer of farmland coming in the next 10, 20 years. Some of the statistics that I had is that I think 60% of the land is owned by people 65 and older. 33% is owned by people 75 or older. 13% of land in Iowa is owned by widows 80 years old and older. There's going to be a change. Now, some of that may stay in the family. Some of it may come on the market. But I think supply demand is probably going to do more to equalize land pressure or land prices than even the general farm economy.
So you have pulse on what's going on in the northern plains, but also getting into Minnesota, Iowa, over here in Wisconsin as well. So what are you seeing? What is the most expensive piece of land that you have seen come on up for sale in the last 12 months?
There was a 80-acre parcel in Missouri that sold for $34,000 an acre. I think an 80-acre parcel in Iowa that was right at that $30,000. Probably even more startling was a sale up in northeastern North Dakota. The numbers really are pretty interesting when you take a look at that. It was 320 acres, so it was a large parcel of land. And on a tillable basis, probably just short of $19,000 an acre. This is for North Dakota land. It broke the North Dakota record by several thousands of dollars, right? But it's interesting. I knew both the seller and the buyer. And the buyer was very well heeled. They've been farming the land for a long, long time. It was a strategic purchase for them. But if you took that same 320 acres and if the seller would have taken that money and just put it into a 5% CD, for example, not assuming any tax consequences, they would have gotten about $280,000 of interest income. The rent that they were receiving for that 320 was only $60,000 minus real estate tax. So why is that next generation looking to maybe sell? That next generation that doesn't have a connection to the farm, why are they looking to sell? That's a good reason.
Do you see much for foreign land investment in the territory that you know best?
Very little. Obviously, there's I call it a firestorm up in North Dakota where the Chinese company were looking to buy 320 acres to put up a corn wet milling deal, whatever. But up in Grand Forks, you got the big Air Force base that's only 10, 12 miles away. And of course, that was shut down. You're seeing more state legislators putting in pretty hard stops on foreign land ownership. Obviously, the biggest foreign landowner in the U.S. is Canada, right? And Mexico is not far behind. But I think there's going to be legislation in just about all states that is going to take a look at that real hard.
Well, thank you for giving us that update on what you're seeing in farmland trends. Another area that you keep a pretty tight pulse on and kind of a key indicator in your world of what to be watching is trends in the machinery market.
There's been a significant fundamental shift in the machinery market in the last 12 or 18 months, right? During COVID, we had a lot of government money. There was a lot of money coming into the ag sector, a lot of money being made. So when farmers have money and they're making a lot of money, they go out and spend it, especially for machinery because it's a deduction to their tax liability. A lot of producers went out, made investments in machinery, equipment. John Deere's in the case of the machinery market, obviously we're having some issues with supply management. Producers were ordering tractors making the deals, but they kept their equipment until that new tractor came in. So when you drove by a machinery lot just about anywhere, those machinery lots were basically bare, right? There was no new equipment. There was very little used equipment on there because that was still on the farm. I think over the last 6 to 12 months, supply demand thing has caught up. The factories have caught up to a point where we've seen some layoffs in some of the machinery manufacturers, whatever. It's caught up, and now all of that used stuff that was traded on the new is hitting the lot, and it's hitting the lots at the time where maybe there's some stress in the farm sector. So you're seeing a lot of buildup on machinery lots, on equipment. Dealers, auctions are putting that equipment out there for sale, often at pretty significant losses for themselves because they see what's coming. They're paying interest on their floor plan, things like that. So we're seeing drops from a year ago of as much as 30-40% on some of this equipment. So if you're looking for good late model used equipment, you probably have a pretty good buy out there right now. But fundamentally, as my dad used to say, there's some storm clouds building in the west, right? A little bit for some of this. But I think the machinery dealers, they're in a real good spot as well. They've done well. They see this coming, and they probably have their finger on the pulse, just like bankers do.
When you put those pieces together, noticing and observing all of these things going on, and one thing you mentioned in particular was layoffs. And we've all seen in the news lately some of the layoffs and some of the changes in John Deere, for example. What is this telling you?
I would say the machinery market is probably one of the first indicators of a downturn. It's ahead of the land. The land market always lags because that's a longer term investment. So that's telling me that the purse strings are being pulled in a little bit, both from the producer and maybe from the banker standpoint, right? So, that coupled with commodity prices that are off significantly, in most cases, well below cost of production, things like that. So I think what that's telling everyone is that don't miss the lessons that are out there. Start bulletproofing your balance sheet and things like that, getting ready for the next downturn that's coming. So, when you come out of that, you're in a position to take advantage of opportunities that invariably are always on the other side, right? And those producers that basically, I won't say do the right thing, but are in I think adversity, you're either subject to it or you're taking advantage of it, right? And you want to be able to take advantage of, and that's the way the world has gone forever. People do well sometimes at other people's expense. So what are the things that you can do to put yourself in the best possible position? You talked about cycles earlier, and I think those cycles are maybe compressed a little bit over time. But it seems like every time we come out of the cycle and go up, we end up at new highs. And I don't know if it's just better producers out there, better managers out there, or maybe you're taking out a little bit of the lower end that just rising tide raises all ships. But I've seen the best operations being built during tough times. They're just taking advantage of opportunities that are out there. So sometimes we get a little bit of doom and gloom what's coming, but with adversity comes opportunity. And we like to see our producers have the best chance of taking advantage of those opportunities.
Well, and you use the term, Lynn, bulletproofing your balance sheet. What does that mean to you in your eyes when you are looking at the producers that are in your portfolio or within your system that are truly using this time right now to position to take advantage of adversity, to bulletproof that balance sheet? What does that look like? What are they doing?
That's interesting. And that's one of the things that we talked about in our blitz over those 3 days is that, especially in the grain market, when we came off, I'll call it the ethanol boom from 08-09 to probably 2012, those were tremendously profitable years as well. And then things just kind of fell off the table. I used the term for the next 5, 6, 7 years. It was like you're wandering through the desert until 2021, 22 came along, at least in the grain market, were the 3 most consecutive profitable years that I've seen in 40 some years. I mean, it was really, really good times. So what does that all mean as you're going into the next downturn? Bulletproofing your balance sheet. I would say get back to the basics. Watch your financials. I can't overemphasize the value of working capital, making sure you got liquidity. Most businesses don't fail because they go broke. They go out of business because they run out of cash. They can't meet their day-to-day obligations. They run out of liquidity, things like that. So it's all about having that dry powder. If you're playing with some house money, you're not borrowing the first dollar from the bank. Doing your cash flows, monitoring them. A lot of times cash flows are done just for bankers' purposes, right? That's not the point. I mean, you need to manage your operation If you need to make a correction midterm on some things on expenses, you do that. We're big proponents of accrual earnings. It's income tax records, we get them, but they're not worth a lot to me in terms of measuring profitability. Doing good accrual earnings will probably tell you 2 to 3 years of an upturn or downturn. You're just putting everything in the right production year, right? You got to watch your leverage, especially in terms of what these higher rates do. We've been in such a low interest rate environment for a number of years that leverage is, it's kind of been I won't say an afterthought, but money's been pretty cheap, right? But when you start doubling interest rates over a fairly high amount of debt, that counts up. But again, knowing the value of working capital liquidity and the burn rates of that, the scenario planning, it's like, okay, if this downturn happens, what steps are we going to take? Now, there's not everything you can do to avoid maybe losing money, but I can tell you, Peggy, that good producers always find a way to squeeze out a profit, right? And even the markets, for the most part, over my career, rarely has there been a time that the market hasn't presented an opportunity to price in a profit sometime during the year. And I would say the big thing is know your break even and your cost of production. Bankers are always big about have a marketing plan. Well, the first step in marketing plan is got to know what your break even and your cost of production is, right? I would say really monitor your family living, your non-earning assets, I call them your killer toys, off-farm income, all of those types of things, because we see, especially during the good times, there's an awful lot of money that's being spent on family living. And that can be a slippery moral hazard for banks to talk about that, right? And again, if you're making really good money and you want to live well, God bless you. I think we're all for that. But if you're asking the bank to refinance debt, whatever, and a lot of that debt is family living, we probably need to have a discussion about that. Bad habits are probably formed in good years. The best loans that I've made are loans that I made in the bottom of the cycle where producers are really focused on the fundamentals. Bankers are focused on the fundamentals. During good times, we tend to get a little complacent, right? We don't necessarily think about where the next downturn is. But at the end of the day, control what you can control. I like to say, don't be afraid, be prepared.
That was a great snapshot of bulletproofing your balance sheet 101 that you just provided for us here, Lynn. And I want to revisit a couple things that you had mentioned and ask if there are some specific targets or ratios that producers can have in mind when it comes to things like working capital, liquidity. Are there some hard numbers that you look at to say, okay, these are the ratios or these are the numbers that we want to see as a bank when it comes to working capital, liquidity, et cetera?
There's the old way of looking at liquidity is like a current ratio, right? 1.3 to 1, something of that nature. I don't tend to look at that. I tend to look at it more in terms of dollars. What I'd like to see is maybe having 25 to 30% of your expenses in working capital. Some people will say using revenue. I like to use expenses because you probably have more control over that. So if you're projecting $2 million in expenses, 30% of that, you probably should have $600,000 in working capital. The difference between current assets and current liabilities. You can get into a whole nother discussion about what makes up current assets. There's different parts of that, right? There's cash, there's inventory, there's accounts receivable. And we've had cases where people thought they had a lot of liquidity because they had some pretty big grain inventory that was priced at a certain level. When they ended up selling that, it was at a level quite a bit less than they had on their balance sheet. So to answer your question, I would say shoot for that 30% of your projected farm expenses. That's a good liquidity number.
You touched on family living. And that can be an area, as you said, can get a little bit touchy, a little bit tricky for you when you are looking at expenditures from that farming business. Is there a percentage? Like, how do you measure, is this too much? Does this family need to cut back? How do you measure that?
That is extremely interesting and extremely hard. I would tell you, though, when we take a look at family living and just toss out and you say, well, the family living comes up to be $100,000, I would argue that it's probably 125, because there's 25, 30% of your farm expenses that are in your Schedule F, right? I mean, I've got a Schedule F. I know what family living things can end up into your Schedule F. So one of the things that I like to do, and not everybody likes to do it or hear it, but if you're spending $125,000 on family living, if you were to equate that into a W-2 wage earner, right, you'd have to have a job that paid you about $200,000 to live that kind of lifestyle. So I just think you need to have an awareness and I really like to see producers have a farm budget and a family living budget. Too often the farm is just an ATM, right? You can just pull out of the farm and have that as family living. I would say those people that are really focused, even again, going back and what are some of the things you can do, just have a really realistic look at what that family living number is. And to do that, have a separate family living budget and to point out what that is.
Thank you for digging into those areas, Lynn. I think that's some high value information, but you're sharing where you're coming from with this perspective. I mean, it's real. It's because you have seen success and you have seen people struggle. And so your experience that you can lend into the realism of topics like this is just so valuable. So thank you for sharing how you look at those things from a lending perspective. And that kind of leads into something else I want to touch on with you, Lynn. And that's when we are looking at this medium net farm income and how you categorize and view kind of that top 20 versus bottom 20%. This was a graph, a chart that you had shared with us during your presentation at AgViews Live. And if you could just kind of paint the picture for what that chart and what those trends look like.
This is called FinBin data, and it's a farm business management that puts together some aggregate data of all farm producers. And it includes grain farmers, dairy farmers, hog farmers. So it's really kind of a collection of all of that. And really what it does is it separates out by gross revenue from 250 to 500,000, 500 to million, million to 2 million, and then over 2 million. And I think the interesting thing about that is, Peggy, that year over year, how those trends play out. So again, you take a look at 2021, 22, pretty much everybody was making money in most segments, right? Even the bottom 20% was making good money, which is always a little bit of a concern, because when the bottom 20% of any industry is making money, that probably is a little bit concerned. In 23 went back to more normal distribution, things like that. But what was interesting a little bit is when you take a look at that top 20% compared to the bottom 20%, what are some of the big differences? Why were those folks doing better than the ones that were not? And it's no one big thing. It's not one. It's a collection. What's a 5% rule? They do things 5% better. Kind of interesting. They get like 12 cents more on their corn. They get maybe 8 bushels more on a production. Their investment in equipment maybe is $100 less per acre. It's all those little things that in and of itself doesn't seem a lot, but when you add them all up, they really do make the difference. And I would argue that a lot of that is down to management. I mean, it really is management focusing on the fundamentals of the business, monitoring them, having a plan. So it is really an interesting dynamic when you take a look at that.
So what you have observed through the trends and this data is that it's less dependent on the volume of gross revenue when you get to a certain point as far as the differentiation between that top 20 and bottom 20, right?
No, it really is. And I can tell you that over the years, there are some large farm operations that do well. And I just want to put that out. But there is a thought out there that the bigger you get, the more profitable you can be. You reach that critical mass or economies of scale. I do see it happening maybe a little bit more in the dairy industry and maybe a little bit in the hog industry. In the grains, I generally don't see that a lot. And the biggest limiting factor is management, right? Because in those cases, as they get bigger and bigger, that main operator, whatever, he's got to realize that he's more of a CEO and he's got to delegate and he's got to have a really solid team around him, right? And they want to handle all the details, and you can't do that. And as a result, maybe there becomes some management shortfalls, and it all becomes just about size and not efficiency. So yeah, it is interesting. And some of the smaller operations are very profitable. You couple that with maybe there's an off-farm income job along with that. So there's some smaller operators that live a very good lifestyle with not nearly the stress. So it's bigger is not always better. Sometimes it's better to get better before bigger.
You really see management as the limiting factor in the level of success and profitability that is independent of gross revenue for the farm. And would you say that when you define management, does it kind of go back to what you shared earlier about bulletproofing the balance sheet? A good management system, a good manager, they're doing those things back to the basics. That's where their focus is. Would you tie those two things together?
No question. Absolutely.
Anything else that you would put under the umbrella of what good management looks like that might be in addition to bulletproofing their balance sheet?
Not everything turns out the way we plan, right? But good managers will have a plan for when the plan doesn't come together, right? In other words, if one of the questions that we'll ask our producers at times, especially in down times, is if your operation loses $250,000, what's the plan, right? You don't want that deer in the headlight look. And at least for the near, probably number one answer is, well, I'll refinance some real estate. I've got real estate equity. And that's okay to do that. As both Dr. Cole and I have talked for years about when you do that, making sure from a banker standpoint that we're building a bridge to get them to the other side of profitability. And you're not just, making a pier where you're leading them out into deeper water where they're going to drown in additional debt or debt servicing, right? So, but that all comes back to that plan.
And running those scenarios and doing it now. That's what you've been reinforcing here in this conversation, Lynn. So I want to take a swing to a different side of this picture of the cycles and of what we should be keeping our eyes and our ears on. And that is really stepping out of what's going on just in the farming trends, but looking at the general economy. And when we get into national debt, and even bigger than that, globally, what we're looking at. So paint the picture for the things that you are keeping your eyes and your ears on when it comes to the U.S. economy, national debt, and beyond.
Well, when you paint a picture, it's, at least in my opinion, it's pretty dark, right? It's not very upbeat. So as much as we talk about potential downturns and risk in the farming, when you take a look at the national economy, I'm just always amazed how few people really understand the predicament that we are in or that we're getting into, right? I mean, we've got $35 trillion in debt. We're adding right now about $1 trillion of debt every 100 days. It's simply not sustainable. I mean, it's beyond me how we continue to do that. Our interest costs on a daily basis right now are $3 billion a day. And that's only going to get worse as we borrow more and a lot of the government debt is rolling over at higher rates, right? From a farm standpoint, why does that matter? Every dollar that goes into interest on national debt is just $1 less available for farm programs, other things that can help producers be profitable. So it really does matter. But there doesn't seem to be any political will to do anything about that. And it seems like it's political suicide to say that enough of this and we're going to get back to balanced budget. We're not going to spend money that we don't have. We talk about the economy doing well generally. It's doing well because of that big deficit spending. Government spending as a percent of the gross domestic product is up to like 25%. It's way higher than it's ever been. So from a personal standpoint, I can live really, really well if I go out and spend money that I don't have and I don't worry about repaying, right? We just got to come to grips with that. And we just tend to put the blinders on a little bit and not worry about it. But it's going to impact us. It's going to impact my kids. It's going to impact my grandkids. So that's the whole developed world gone into a massive amount of debt. I don't know where all of this lands. Is it correctable? I think it is. But the longer we wait, the medicine is going to get real tough to take. But it definitely impacts the farm. You can't separate that out.
In your perspective, in what ways does the ag economy feel or will continue to feel the impacts of this extreme debt load and building debt?
I think in a couple ways. Obviously, number one is producers' borrowing costs, right? Because the government's borrowing more money at a higher rate, and money that's pretty expensive. So, just in terms of what money costs. I think the other thing, even from a global economy standpoint, is the more stress there is in a global economy, the less money they have to buy our products, right? I mean, one of $5 of farm income still comes from exports, and we are definitely losing our competitive advantage in that area. And if there's another thing that concerns me in agriculture a little bit is producers are phenomenal about producing the product, right? Whether it be corn, soybeans, milk, hogs. I mean, we knock it out of the park there. You still got to have a home for it, right? You still got to have somebody to buy that at a profitable price. And that probably is what concerns me the most is that we've got all this product, but can we sell it? Is somebody going to buy it at a level that's going to be profitable, right? Yeah. You can't keep building bins. You can't keep adding cows at some point. One of the best lines always talking to a lot of my banker friends that lend a lot in the dairy, when times are good, the solution is add more cows. When times are bad, the solution is add more cows, right?
See, you are a dairy guy, aren't you? You got the motto down. So, okay, so let's take what you just shared and let's shine a global light on that and expand it from the world point of view.
I think, again, getting back to, the U.S. being a competitive supplier of global exports. I'll go back and take a look at Brazil, the Southern Hemisphere. And again, I think that's a trend that a lot of folks don't understand how serious and how quickly that's changing, right? Brazil they're adding like 4.1 Iowas every 10 years to their production capabilities. They're already the largest soybean exporter. They're rapidly going to overtake the U.S. on corn. They've got 240 million head of cattle, and we have 90. I mean, they're just huge, and they've got a whole lot less government regulation that allows them to do that. So to think that we've got the corner on producing and exporting, we don't have that anymore, or we don't have it to the level that we used to have, and think that we were going to be the world's supplier, the world's breadbasket of all these commodities. We're not. And now, granted, we've given most of these countries the technology to do that. But I think the other interesting thing is where you do have opportunities, go over to the African continent, and that's where if there's population growth or young population growth, that's where it is, right? A lot of those countries don't have the economic means to buy what we have. So all things considered, I mean, if we could find the next ethanol, whether it's sustainable aviation fuel or there are other things that we can do with the commodities that we produce that can create value or have other uses other than just bulk raw commodities, I think that's where it needs to go. But all of these things, you probably need some government support until you get to scale. You just got to do that. I won't say you got to get the government out of the way, but you got to get that regulation down a little bit. And that, quite frankly, might change a little bit with the Chevron Doctrine.
So you just mentioned that, the Chevron Doctrine. And enlighten those that aren't familiar with this. What is the Chevron document, and why should our farmers listening care?
Well, number one, I'm not an attorney, but Chevron Doctrine actually came in about 1984. It was a Supreme Court ruling. So it's a 40-year-old ruling that was overturned basically, I think at the end of June by the U.S. Supreme Court. And what the justices said is that they sent a clear message that Congress, not the federal agencies, is responsible for making laws. So right now, my understanding is the way it works is that Congress passes some, I'll call it some vague laws or whatever, some not a lot of detail. They give it to the regulatory agency like the EPA, right? And say, help clarify the intent of our legislation. And by the way, you can enforce all of this stuff that you come out with your intent. It kind of takes Congress off the hook, takes courts off the hook a little bit. So what Chevron reversal said is that, no, you can't. Congress, you've got to be responsible for it. Courts, you've got to be responsible for it. You can't have a runny-nosed 24-year-old kid in Chicago telling a farmer what constitutes a wetland, right, with limited recourse. So I don't know where all of this goes. I think it'll be really, really interesting, but it's certainly got the intent to maybe reduce some regulation. Now, it may clog up the courts, and who knows where it goes, but this has been such a big weight that's weighed down agriculture a little bit because we've lost the common sense thing, right? I mean, we all know farmers and producers and ranchers and dairy farmers that are phenomenal stewards of the land, and they do all the things right. Maybe you've got a sucker fish that hasn't existed for 10 years, and all of a sudden, they tell you what you can and cannot do, and they want to fine you, and it just slows down. And even from a renewable fuel standards and things like that, it's got a lot of potential impact, not only to agriculture, but energy and healthcare. This is going to be an area really, really worth watching.
Lynn, you have been highlighting these areas to watch. And just to recap, you just mentioned this Chevron Doctrine that as producers and agriculture and professionals, we should be keeping our eyes on and what that could mean. And hopefully it's some good things, some opportunity that could open up. But other things that you mentioned, we covered the conversation about farmland, trends and values there, machinery sales and trends, and the forbearance that may be for what's to come. We talked about farm income and what that looks like, what the best producers are doing right now to position themselves to take advantage of adversity and to bulletproof their balance sheet. And then we also took this bigger swing at the general economy as well as what's going on globally. And so, Lynn, first of all, I thank you so much for just sharing your insights and sharing these trends, but more importantly, really sharing your years of experience of being a farmer yourself and at your heart and core dairy farmer, but also what you've seen over the years. And you mentioned early on in our conversation today that you cut your teeth in the lending world with farm credit, and you walked right into what you didn't even know was going to be the greatest farm crisis in our history, in our time. So I was a pretty little kid back then. You were just walking into that space. But I think a lot of our listeners, they may not have a recollection and a memory of what the 80s was like, but perhaps they heard stories from their parents and their grandparents that impacted the way that they farmed. And so I would just appreciate, Lynn, if you could share with us what's one or two lessons that you learned from the worst of times being in agriculture lending that we can learn from through you today.
Back in the 80s, when I first started, I was literally run off the road. I looked down the barrel of a 357. It was some really, really difficult times. I used kind of the metaphors like there was a fly in the forehead and we took a baseball bat to it. One of the things that I like to tell both producers and bankers is that if you're under 45 years old, talk to a banker or producer that went through the 80s, right? This isn't the 80s again, and I wouldn't want to give that impression. But there are some balance sheets, everything else are in much better position. But there are some lessons to learn from the 80s, especially as we're going into a higher interest rate environment, higher inflation environment. And the numbers, big difference between the 80s and now is that there's so many more zeros and commas in statements and in P&Ls, profit and losses, and as much money as producers have made, they can lose that much money. So the numbers are very different, right? Not that there wasn't some issues, and some folks were going to get taken out. But the 80s took out some producers that maybe shouldn't have gotten taken out. So I think the lessons learned is that step back, have a good banker, don't pull the fire alarm right away. Just understand lending is still a combination of the art and science, right? Science is the numbers, but you still got the art. You got the gut instinct and the intuition and experience, everything else, and you got to blend the two. And it's still a personal business. It's still an emotional business. It's unlike commercial lending. And I always tell my staff, you can take an ag lender and make them a commercial lender, but you can't go the other way. They just don't understand the ups and downs and the cycles and the one inventory turn in many cases that ag has. So there's some good lessons to learn from the 80s. And again, we're not the 80s, but we're not immune from a significant downturn either. And as we've gone through a number of years, our asset values are going, and there's still people that are relying on their balance sheet and appreciated assets in their farmland and things like that. But you can't take your eye off the ball, whatever, especially in good times, and think that they're going to last forever. So do the right things, control what you can control, and manage around the uncontrollables.
And Lynn, that's some good, solid advice that comes from some good, solid years of experience and knowledge and wisdom. And you just did exactly what you were describing, and that is to take the numbers and put the art to it to connect the dots for all of us today here that are tuning in for the Up Level Dairy podcast. Lynn, I hope that our listeners have been able to pull a few nuggets out from what you've shared that will just help them be better positioned for their own future by being able to learn from the past, but also keep their eyes on the trends that are going on. And you gave us a fantastic list of what those things are to keep our eyes and our ears out for. And so with that, Lynn, I want to thank you so very much for joining me on the Up Level Dairy podcast. And if you would like, maybe just take a moment and share a little bit about AgViews Live and give them a little preface on what AgViews Live is and how it can be a benefit to them should they have a chance to attend one of these live meetings that you put on during the summer.
Sure. We've done this now I think this was our 10th annual event, and Dr. Dave Cole and I have done this for all 10 years. But really what we do is we kind of peel the curtain back and look in real time with what's happening with producers. And a lot of producers obviously just see one operation their own. I see 100, 200, whatever. And so as a result, you can probably draw some conclusions and best practices and things like that. But really what we're doing is we do one in Fargo, one in Sioux Falls, one in Wisconsin Dells. We're just sharing information. We're not asking for your business. We're not doing anything. We're just sharing our thoughts and our opinions and what we see and educating. And it really has been and what's interesting in a lot of these is the diversity of the people in the audience, right? We've got bankers, we've got producers, we've got banker regulators, we've got politicians, we've got agribusiness people. When most of these areas, in all of these areas, no matter if you live in South Fargo in a metro area, what goes on in agriculture affects you. I mean, we still are an ag-driven economy. And so if you don't think that you have a connection to agriculture, you're wrong. So we try to make that tie that this is still a rural economy in all of these areas, and it's important to know what's going on.
Well, I'll tell you what, Lynn, I sure enjoyed being in the audience for Ag Views Live, and I will make sure that as that event gets on the calendar for the summer of 2025, we give you a shout out here from the Up Level Dairy Podcast. It's a free event and extremely dedicated to the purpose of educating and telling those stories between you and Dr. Cole, and really a high value event that is a generous gift to the ag community to be able to have a seat in the room for. And again, I thank you for taking the highlights of what you shared that day at Ag Views Live and sharing it with us right here on the Up Level Dairy Podcast.
Appreciate the opportunity, Peggy. Thank you.
I hope you've taken a few notes here from Lynn Paulson with Bell Bank. I'm Peggy Coffeen, and thank you for listening to the Up Level Dairy Podcast. And if you aren't already getting these messages in your inbox, make sure you head over to upleveldairy.com, where you can join our Up Level Dairy community. And when you do that, every time a new episode drops, we make sure it gets right in your inbox so you can listen right away. Never miss an episode by joining the Up Level Dairy community at upleveldairy.com.